GKFX Prime presents the Market Analysis Webinar.
Hello everybody, welcome to our weekly webinar video. So we're looking ahead to the rest of the week and analysing the major price moves out there across some of the major asset classes, including Forex, indices, and you'll see at the moment cryptocurrencies. Not going to spend a lot of time on this, but the biggest move over the weekend is that Ethereum has smashed through the 3,000 level. You can see that on the chart here. So big move in Ethereum. I'll also talk a bit more about Bitcoin in just a moment, as well as the other asset classes that I mentioned. But big move in Ethereum, very bullish chart right now. Certainly one to be, perhaps not buying at the highs, but you can see that dip buying has been a very successful strategy as of late with Ethereum in what it continues to be a very bullish market for cryptos. If there are any other markets you'd like us to cover in these videos, please drop a comment in the video, or otherwise just click that like button and more people will see it on YouTube with the algorithm, and that always really helps. So let's jump through to the euro. Looking a little bit complicated on the 4-hour chart, but zooming out for a second, you'll note that last week we were talking about how we'd kind of broken through potentially a sort of consolidatory trend line, broken through to the top side, but we had a sharp decline in the euro on Friday. Obviously a big dollar rally. It was non-farm payrolls, and there was big bumper number, and also the dollar had been hit pretty hard across the month, and it was the last day of the month, and we saw a big rebound in the dollar. So that's it really. What is now an open question is whether we're just pulling back to test this broken trend line, or if indeed this rally is just a dead cat rally, dead cat bounce rather, and the market's going to continue lower. Zooming into the kind of time frames that we'll be dealing with over the next week. This is the rising trend line that's been supporting this recent rally in the euro, and you can see that it's quite well defined, and it's in this last leg lower on Friday was very clear. It broke below it, came back then on the next period on the 4-hour chart and slumped down, and so this looked pretty bearish over the short haul. Now we've basically stumbled around near the lows of that big bearish candlestick. What I would imagine would be the first step here is that we get some kind of retracement move. Now that could be to those former lows down here, and if that's the case, basically this is where the market could roll over, starting around 120.50, the round number, but going up through those old lows, potentially rolling over to where we have a confluence of support beneath the current levels, which is where we have both that broken long-term falling trend line that I mentioned, also these former highs. If we again look at the daily chart, you can see it's these former highs through here. On the shorter term chart, you can see it's the highs that were in place before we had that big breakout move. And it's just above these former lows down here. And it's all just happening just below the 120 level. So 120, those former highs, potentially even the 38.2 Fibonacci of the rally, all pieced together, suggests potentially this would be an area to look for. If we get a rebound higher, potentially up here is where it could get interesting into these lows. Obviously got 121 above there, and then a drop down to here, and then we've got the 200 period moving average on the 4-hour chart below. So that's the overall kind of basis of the trend, some levels to look out for. I think if we do, this is kind of the line in the sand, this confluence area down here. If we drop through this declining trend line and through these other confluence levels, that's when the market starts looking a bit more bearish to me, and we look more likely for a drop down to that 117 again. Switching gears to the British pound, which actually looks a lot softer than the euro at the moment. This is the daily chart. let me pull out to the week. No, if I can just zoom out on the daily chart, you can see the picture a bit better. Fairly well defined rising trend line here, right? So hence the rising trend line plus those kind of two matching lows down here provide the basis for where there could be some area of support to see the market bounce. So you can see that we've tested the 140 level, bounced up, made a lower high, now made a lower low. So pretty kind of bearish within the context of this trading range. If that bearishness bears out and we drop further, this 137, the former lows and the rising trend line, again, three reasons to suggest this could be an area of interest if the price drops down there again. Obviously the matching low is kind of an obvious one, but if the market does still maintain a kind of overall bullish bias, then 137, the round number, could be enough, especially, given we had this big rally up. We haven't been able to build on it, but maybe people will still be looking at that rally area, that rally that we had, and hopeful that we can eventually break above 140. So for the bulls, 137 is a kind of value area potentially. Again, thinking more about where, if we are going to get, we had the sharp drop on Friday, just like in the euro. If on the short-term basis we're looking for just a continuation of that Friday weakness, then we're just kind of trying to judge, where if we do get something more extended bounce to offer us a more value area to sell into, we're thinking about where that might be. So obviously that's the recent decline, high to low, drawing in the Fibonacci's. You can see 139 basically sits right in the middle of the 50 and the 61.8. So somewhere in that area potentially could be interesting. In the euro, we drew these lows through here. That might be enough. The market might just come into those old lows and roll over from there. But even if that does prove to be true, it's one of those situations where it could rally all the way up to the former high, and so what do the kind of the risk to reward is not so good. Wrong kind of line. If I draw just a trend line, if you're trading down from that, and then you're getting more than a 1-to-1 potentially, but it depends where depends where you put your stop loss and how you manage this thing. But just with the idea that it might not get this high, but it would just offer a better trade if it did. That's the kind of idea that, this versus this in terms of potential risk on any looking to fade any move higher here. Right, switching gears to dollar yen, and this was the most prescient suggestion that we made in recent days, was this calling out this 50% Fibo and the kind of pin bar hammer pattern at the low here. I didn't think it would be this effective, but it was nice in the end. We had several days of gains, that dollar strength really throughout the week. Now we're just thinking about where does this carry us next? Overall, obviously in quite a kind of bullish mode for dollar yen. It sort of tried to break through this support, but basically, if we had a kind of line through here, sort of tried to break down, but just rallied straight back and carried on. So this market looks pretty bullish to me. And so I'm just jumping down to the 4-hour chart. We've had a nice run up through here, but if we are able to drop down through to that form, because we haven't had any retest yet, we just rallied straight up. It's looking very strong. But if some sort of bad news for the US has come out, knocks the market a bit, that could be our opportunity down around, pretty much down near 109. 109 is just under our line there. So that's potentially what we're looking at. But we're at 109.66 at the moment. A 66 point drop. If you're a bit more aggressive on it, then you go for that spike high, and that comes in around 109.20. If you think this up move can continue. Where might this up move begin to fade? Well, the big 110 number is an obvious one, and we had the two failures just before that big level previously. So a small confluence of the former highs and the 110 level, and just the fact that this market hasn't had much of a correction, so it's going to get pretty overbought up here. Are two reasons, not necessarily to trade it right down to the lows near 108, but maybe an area where a bit of weakness comes in after this big jump. I think through 110, if you're looking at it the other way around, it's potentially an area where the weakness comes into the market. But if it doesn't, and the market keeps going, that to me is a pretty bullish sign that we're heading up to the highs, and that dollar yen is maintaining its overall uptrend. Oh, one last thing to mention here, I almost forgot. Oh, it's almost too busy on our chart right now. We've had a look at all those short-term issues, so let's remove some of this. These arrows especially just don't seem to change size depending. Oh no, lost the key thing. Go on, arrow. You know you want to do it. Get rid of you. Apologies. This is just this happens on different time frames on the trading platform. But this is just what I wanted to quickly point your attention to. Downsloping rising trend line, and I talked about the breakout here, and then last week I talked about how this was potentially problematic if we close back down through that rising trend line. What happened is we dropped right through, but we rallied back up and closed above this descending trend line. Now, to me, that's fairly significant, along with the kind of bullish price action that we've had here already. 3 big monthly gains. Then we've just had the corrective move last month, but we actually managed to rally more than 50% off the lows, and hence that long wick on the monthly candlestick. And importantly, I think above that declining trend line, suggesting that we've got more upside to come. Right, switching gears to the Aussie dollar. Again, a kind of interesting one here. We've talked a little bit about this head and shoulders pattern, left shoulder, head, and then right shoulder, and then the failure pattern, which we pointed out at the time was a good bullish indicator. When a pattern fails, if you have a trade on and it doesn't work out, obviously that's not so good. But the positive of it is that if you can just flip around your thinking very quickly, you realize that actually the failure of the pattern is in this case failure of a bearish pattern is very bullish, and we rallied straight up to the former neckline again. The top of the shoulders. But what's been more interesting recently is we've just really struggled to get through that shoulder area, and we've had 3 failures there. So to me, that looks pretty bearish in the near term. The fact that we just can't get through that 78 level, basically. And so then if we drop down to our 4-hour chart, this is the consolidation area with the 3 failures. To me, once we get through 0.78, that's bullish, and we get that breakout. Equally, the fact that we've been failing to do so, to me, looks like probably more likely, and especially in the context of these other charts where the dollar looks quite strong, looks more likely that we get a break to the downside of this area. But I'd be hesitant to really trade the inside the range. Hence, I think probably with just such a clear range, you're either buying at the bottom of the range, selling at the top of the range, but that's already worked a few times. I think we're probably nearing a breakout, and so in that case, trading the breakout to the downside once you get a break through that level. I think that's probably the safest level, but you can see that actually what's really been going on is that we've had these lows through here, which really started this off, and we've just had a couple of false breaks already. So just to try and avoid yourself getting caught in another one of those, maybe just put your entry point on any short trades would be a little bit lower but you can see that's basically been a trading range that's been in place for a while. Hence, it seems more likely the breakout's coming soon after already having touched this support of 1, 2, 3, 4, 5, potentially 6 tests coming up. Even today was another test. If you don't fancy if you think this bearish breakout's coming, but you think maybe we can get some better prices if there's a bounce back into the range, well, this is pretty much the midpoint of the range, and you can see here, 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 and more recently here, it's been a kind of pivot area. So if we do get a further bounce, again, you could look towards that 7550 in essence, 7750 in essence, could be in the middle of the range there. Switching gears out of Forex into commodities, and here's the oil market. So various trend lines that can be drawn here. I did, if you remember from last week, have a trend line that was more sort of through these lows, and that's still viable to some extent. There's different ways of drawing it. There's a kind of broken one up through here as well. This just seems to have been what's in play recently, so just drawing it right through that low there, and you can see it's just connecting all these lows through here, seems to be what the market's paying attention to. The way I'm thinking about this oil market right now is that it does look a bit dubious, it looks a bit toppy, but let's just keep this trend line that everyone's watching in play, and just try and stay bullish while we're above that rising trend line. Note that we've just run into 65 level and pulled back from 65. To some extent, it's natural that we'd get to that big round number and there'd be some profit taking. So not necessarily a huge warning sign, but it was a bit of a steep move. And it's actually carried us down to the 50% retracement. So this is an area in itself where we've already just made a low here. It was the 63 level, so we basically couldn't hold above 65. We've pulled back $2 to 63, which is also the 50% pullback of this rally. So I think that's potentially an area of interest. The next one is just these former highs through here, which basically we had this little kind of base above the trend line. We rallied up, and it's basically the trend line again. The trend line again, the 61.8, and the highs, and 62 arguably. So that kind of rectangle through there, if you like, if we continue lower, is the next area of interest. But just the 63 level and the 50% retracement in itself, quite interesting, I think. And also the fact we put one little low in, and we seem to at the moment be sort of false breaking. If we can kind of close positively with a little fakey below and close higher, I think that would probably be a positive result, and get another attempt up at 65 again. But definitely worth watching 65 in the context of the overall situation that looks a bit toppy. Have after that move up to 67. Moving through to the gold market. So I've changed some things on this chart, but more or less the important aspect is the same, which is that we had this basically the double bottom. Double bottom there, the neckline. This is the height of this double bottom pattern projected up. So if this double bottom holds and the market is indeed bullish, we really should be aiming up there at a minimum up here. But we've struggled. We actually had another kind of head and shoulders pattern happening in here, and we had a false breakdown. We touched the neckline again, and we've rallied up since. For me, the way I'm thinking about it is, well, if we do just think of it in terms of classical technical analysis, if we get a move below the neckline, then to me, having not reached the target, that is kind of classical technical analysis of a bearish signal, and I'll be turning bearish below the neckline, and then you note that 1750 is just below, so really below 1750 is a big kind of round number to pay attention to. That would be when to turn bearish down there, not while this chop is happening. Again, if you want a better level to turn bearish, then the shoulders of this shorter term head and shoulders pattern offers some potential value up there. And again, if we can break through to the top side, well then great. What we've done is fairly classic, even though it's taken a while to do it. Broken the neckline, come back and tested the neckline, and then rallied up towards the target. Is potentially just what's happening here. For me, I'm a bit nervous because this is really taking a long time. And so looking to turn bullish again once we get a break above the peak, and potentially still some decent upside towards the target. So I think that's the lay of the land here. It's looking a bit dubious for gold at the moment, and that makes sense in terms of all these other charts we've been looking at, where the dollar's been looking quite strong. So either waiting for the pattern failure, or waiting for a better price level up here, for just a third failure really at this these showed us patterns, or just or waiting for the confirmation that actually the market is still bullish with a move up through and above 1800. Switching gears to the S&P 500, probably my most controversial thoughts, or not really, I suppose. But here I've got, you notice I've got the RSI on the chart. I had it in there last week because we've got the most overbought we've been for quite a while in the S&P. Definitely the most overbought we've been in 2021. And there's just a bit of bearish divergence. So the RSI has made a lower high, whereas the price has made just a narrowly higher high. So that to me is potential bearish setup here in what is obviously a very bullish market. But just there's a logic for the bearishness. Playing this indicator pattern, the bearish divergence. Obviously, you can just see by the price itself, it's not been down to the 200-day moving average in, it's not since almost a year since we tested the 200-day moving average. It was June last year, and really been levitating since November. So just a deeper correction, potentially just to test the 4,000 level. We broke 4,000 for the first time, obviously, and we've just gone almost vertically since. Stalled a bit recently. Now to potentially where the RSI diversion pattern happens, and it's just another one of these. We're not necessarily calling for a crash here. It's just a dip in the market, and you can see even that it's just would be an equivalent kind of size dip down to the 4,000 level. I also thought just kind of interesting to note that in terms of stock markets, obviously people tend to look at sort of percent declines as well, and they also look at the year-to-date performance. And something you'll read in the news a lot is the S&P 500 has turned negative for the year, and if on the last two bigger corrections that we had, that's actually interestingly what happened. This is the first trading day of the year on January, and in this dip, we dropped through it, turned negative for the year, then we made it a bit higher again. Then we also dipped right down to that, turning negative for the year, but rallied out of it. And on the last one was just a very small little decline and didn't get anywhere close. But if we do get more of a monster decline, that would be a potential support area to look for. Oh, we turned negative a year, everyone turns negative. Oh, and we just bounce by the dip and move higher again. And last but not least, Bitcoin. I had been turning a bit cautious on Bitcoin, but wrongly, as is often the case with Bitcoin, such a bullish market. We noted that Ethereum at the start of the webinar is at record highs. Bitcoin's been moving higher with it, though underperforming on a kind of price basis, ceding market share actually to Ethereum. There's been a lot of good news around Ethereum. And obviously the Ethereum futures kicking off as well has created a lot of excitement on the CME. What's good about this Bitcoin chart at the moment is that we had this rising trend line through here. We tested it, tried to drop, and then we just had these 2 days of real strength, and we've carried us back through that rising trend line. Next risk area for me is just where we had this kind of rising wedge pattern, which did turn bearish, which did have a kind of fairly bearish result. If we go down to the 4-hour chart, we can see it quite well, that if we were to close this gap and meet the 76.4 Fibonacci level and touch this rising trend line on the bottom trend line of this rising wedge, they all come in that sort of not too far above where we are, depending on how quickly the price moves. Something like this kind of area. And notably, it's the 60,000 level. 60,000 is right there, where we basically gapped down through the fixed 60,000. Now we're back above and we're approaching 60,000 again. So the question is, and whether you want to trade it or not, is does Bitcoin stall again at 60,000 and turn significantly lower? Seems unlikely for a very bullish market, but that would just be an interesting look. Even if we didn't get anywhere close to the lows again, where we dropped down to 47,000, even if we don't get close, it's a very volatile market. You could turn short-term bearish at these levels potentially with all this confluence in there. It's also where we first hit 60,000 is a big level. So if you're kind of talking about this might be more obvious on the daily chart, but if you're talking about kind of hit the level 60,000, made the attempt to break, then basically failed, gapped lower, and now we'll come back to it again. And so you're almost talking about a kind of head and shoulders pattern again. Left shoulder, head, potentially right shoulder, and unlikely, but still, as I say, potentially an interesting opportunity. And as always, if we get above through the 60,000 level, then we can assume this correction's over. And of course, we're late into it, but we know from the history of Bitcoin that it can still move a long way past the highs. All right, that's it. Thank you very much for watching this week. Please subscribe to these videos if you want to be in time and get the next one as soon as it's released. Thanks, everyone. Good luck trading this week.